Good afternoon, and welcome to the closing session of Energy Finance 2021 Online. I'm Sandy Buchanan, Executive Director of the Institute for Energy Economics and Financial Analysis, coming to you from Cleveland, Ohio. Our closing session is called The Energy Transition is Here, Where Are the Investors? Before we start our session, I want to explain how our question and answer period will work. You'll see in the lower right-hand side of your screen a chat box. Please put your questions in there for the speakers and our moderators will relay them. You can also use that chat box to interact with other conference attendees. I'm now pleased to introduce Larry Shapiro, the president of IEEFA's board of directors. Larry is the associate director for program development at the Rockefeller Family Fund in New York and the co-founder of the Funder Collaborative on Oil and Gas. Larry, let me turn this over to you.
Thank you, Sandy. I just want to speak briefly. I hope everybody's gotten a lot out of this year's virtual conference. IEEFA has come a very long way. At our first Energy Finance conference in 2011, we had about 60 people gather in New York at the NYU Law School to discuss domestic US coal and the electricity sector here in the United States. Over time, we've gone international and we've expanded the scope of IEEFA's work and of course of this conference to include oil, gas, and much more. 2 years ago, the last time we had an in-person conference, it was at Columbia University Law School in New York. We had people from 33 countries. Last year at our first online conference, we had participants from 32 countries. This year we have 979 people registered and they're from 55 different countries. IEEFA has gone from, I guess from nothing actually at the beginning to having 50 people working for it all over the world on a very wide range of finance issues associated with fossil fuels. I think we've gotten really good at running an online conference, although we certainly missed something by not having the kind of informal interaction that takes place at in-person gatherings. So I hope next year. I really want to thank and congratulate Sandy and the rest of the IEEFA team for making this conference so successful. It really seemed flawless as far as all the logistics, and I'm sure that was difficult. I want to thank all of you for participating, and I hope you participate next year as well, whether online or in person. I'm now pleased to introduce Melissa Brown, who will moderate today's session. Melissa is IEEFA's Director of Energy Finance Studies in Asia and a former securities analyst at JP Morgan and Citigroup. She's played a leading role in various Asian investment organizations focused on mainstream and sustainable investment strategies for public and private equity investors over the past 25 years. Now let me turn it over to Melissa and to our panel.
Thanks, Larry, and thank you, Sandy. I'm delighted to be here with a great panel today, and to get our session started, we'll have 2 short videos for you to watch to give you a sense of who our speakers are. The first speaker is Diederik Timmer from Sustainalytics, which is one of the leading global firms that provides research and data to investors on environmental, social, and governance issues, or ESG issues. Our second speaker is Tanya Kar from the Sunrise Project, where she works with a diverse network of organizations on investor-linked climate finance issues. I hope you'll enjoy the videos, and we'll see you shortly for Q&A. One of the biggest challenges for people who've been working in the energy transition field has been the best way to identify smart strategies for engineering real change in financial markets. We obviously need to know how to price climate risk. We need to know how to identify investments that align with realistic climate pathways. And we need to figure out ways to ensure that investors know what they're investing in. So to help us get a sense of what the issues look like from the inside of the investment field, we're joined by Diederik Timmer of Sustainalytics, one of the leading ESG data providers to global asset owners and asset managers. Diederik is a part of Sustainalytics' executive team. He's managed the firm's commercial activities and strategies. He's also involved in industry outreach on policy issues as the chair of the US SIF, which is the Forum for Sustainable and Responsible Investment. Diederik, thanks for joining us. I'd really like to think that your experience gives you a firsthand view of how much work is involved in fixing the plumbing of financial markets. And when I think back, I know, I met you 10 years ago. ESG was new, climate risk was growing as really the crisis that it is, but it was ignored. You're European, the Europeans were the leaders, US investors were, to be blunt about it, completely asleep at the switch. I'm really curious to know, where do you think we are now? You've been working with US investors intensively for the past 5 years. What makes them pay attention?
Well, thank you for having me today, Melissa. And I think your question, is an interesting one because it also relates so much to my move over from Europe to the US and the experience that I had and how I had to figure out how to better work with US investors. So it's both a professional journey as well as a reflection on the field. So I'll try and split the two. I think I should probably start off by saying that for me, the investment space is not a homogeneous field, right? And maybe the easiest way to describe the field is that you have asset owners like pension funds, insurance firms, then you have asset managers that create investment products, and then finally you have the retail investor and their advisors. And I think they operate in very different ways and have different objectives. So I think it's hard for me to just use one paintbrush to color it all. But what I can say is that when I moved over, the first thing I did is to visit a lot of these large asset owners in the US. So I went to see the big state pension boards. And I think the one thing that struck me at the time is that you had a few really large ones that were super active, like CalPERS and Florida State and UAW. But then when it came below that or in other states, there was very little. And actually, I had to explain to many individuals working for these organizations what sustainable or ESG investing now really was. And I think we're really beyond that point, especially in the institutional asset owner space. I don't think that there's many professionals that haven't heard about sustainability or ESG and how it relates to their investment decision making. It doesn't mean that they're all doing things, but it certainly hit their radar and they have that first level of awareness. And I've slowly seen a lot of these asset owners taking up more strategies. And what I'm seeing is that when you look at the asset allocation that they have, then typically in that second tier, the smaller, maybe less pronounced organizations on sustainability are putting things in their alternative section of their portfolio. But what I see across the board is that it still hasn't gained a lot of traction within the normal allocation. So within their normal equities portion of their portfolio or their normal fixed income portion of their portfolio. And I think with that, the US is really significantly behind what, for instance, is happening in Europe, in Australia, or in Japan, for instance. So on the flip side, I have seen a really significant uptake of the interest in sustainable investing in the retail and wealth space. And I think that also makes the US unique, where the main driver for the growth and interest has been the individual that just asked their advisor, can you help me out? I would like to invest in a way where my values or my interest or my concerns about climate are also reflected in my investment portfolio. And I see a lot of the growth actually coming from that space. When it comes to the asset managers, I think it's important to note here that asset managers are operating globally. And it means that these asset managers, the big ones you all know, are mostly responding actually to demands coming from Europe and from Australia and from Japan and other locations. And as the demand is developed there and products are developed, they are also willing to offer it in the US market, but it's less central to their strategy. I do think in the last year, things have really shifted. The change in the political landscape, I think, has put it even more firmly in the center of their strategies. And I see big movement there, but it's really quite recent.
Diederik, what you're describing is really fascinating to me because, again, I'm familiar with this institutionally driven process out of Europe and in other markets. And now we've got this bottom-up process that's at play. Obviously, a big issue with any financial market scenario is where is government policy? You've pointed out clearly we're essentially at a change point. We're seeing a lot coming from the Biden administration. What needs to change at the Department of Labor, at the SEC, at the Fed to ensure that energy transition and climate risk factors
really are addressed as critical financial issues.
Yeah, and at USIF, we've been deeply involved in policy for many years, and we've been interacting with many of these organizations also throughout the last administration, which has really helped to build up relationships. And I can tell you that ESG and sustainability weren't particularly popular topics at the time. And I think now with that change, it's really interesting to see how the momentum is shifting as well. But it does mean that we need to start from the beginnings, right? And I think within a lot of these organizations, like the federal government or within the SEC or Department of Labor, there really is a lack of knowledge, a lack of understanding of what, for instance, is needed to uh, adapt towards, climate action. How does that relate to the investment side? And um, I think the first really big thing that needs to happen on all fronts is that the leadership as well as the departments just need to make sure that they get adequate people on board so that they can also have a meaningful conversation internally and can create structures that make sense. But that capacity building is really deeply needed. And a way to do that, for instance, is that with USIF, we've asked for and we've really strongly recommended to create a advisory committee as part of the White House that is really focused on sustainable business and finance. I think it starts there. There you can build up some capacity, work on cross-departmental activities, and build that knowledge that also helps implement policy that is in alignment with what we're looking to achieve. So that's the first part. Then if I'm looking at the SEC, with all the right intentions, really has a lot of catching up to do. And I really hope that they will hire more people that have knowledge on this front. And then basically they just need to develop policies that support environmental change. And one of the other things that I would really recommend the SEC to do is to start enforcing more strictly also on what asset managers are doing. Basically, a lot of asset managers and products are being created that state that they really have significant positive impact on the environment. And I think it would be really good to make sure that the SEC, for instance, validates that these claims that are being made are actually there so that we get away from the greenwashing that's going on. On the Department of Labor front, there's actually some really exciting developments there. And the most recent development is that there was just a bill proposed by the Democratic Party to do something about the ERISA guidelines and to make sure that uh, it's seen as part of the fiduciary responsibility of an investor or of an asset owner to look at climate factors and to do this in a way that is consistent also with their fiduciary responsibilities. And so far, this ERISA guideline was actually a significant hindrance for many trustees of pensions to, for instance, accept ESG or climate criteria as a important metric for investing.
Thank you for that, because one of the tough things that certainly our community has been having to get to grips with is exactly the right issues to focus on at the right time, and where necessary to be just as technical as the inside experts. With that in mind, I want to pivot quickly to a final question for you, really about the ESG data providers. That's where you live and breathe, in and out. But I'm really curious about the fact that the ESG data providers are really now under the spotlight. There's a certain amount of complaining. There are, the usual, not the usual, but actually some really meaningful academic studies beginning to compare Sustainalytics ratings with MSCI ratings, and really asking some good questions about, what do the ratings mean? Is that the right way to think about the work that you do? And also the real risk that you're providing a roadmap for greenwashing. And that leads to a question of, is the promise of sustainable finance actually really in serious need of repair right now as well?
Well, I think that's a really interesting question too. And I like the way you position it. So let me start off by saying that as an organization, we have an important function. And that is still a lot of the corporate reporting is really, really weak. And it means that for investors, getting that reporting and understanding actually what companies are doing and the outcomes they're generating is still really limited. A lot of investors invest in portfolios of 9,000 companies, and they basically need to understand all the companies they invest in and need to get normalized and structured and insightful data that helps them manage these big portfolios and these really complex questions. So there's not a small task at hand. And it means that the ratings providers like Sustainalytics or others have an important function to fulfill that many of these investors can't do easily themselves. So that's why we're there. And I think it comes with a really great responsibility. And I think it's crucial that as organizations, we innovate. And I think when you innovate, it also means that, for instance, ratings are not always aligned anymore because you change methodologies and you change approaches and you want to measure things more effectively. And a really good example is that we just changed our methodology 2 years ago, in our view, to create a far better reflection of the risk that a company runs and how they're managing it. But it also means that it's no longer aligned necessarily with the other ratings that are out there. So innovation and a criticism around there's no consistency among rating providers, I think just is a demonstration of the field that is not so mature yet based on quite weak data. And then maybe the last point I want to make on this front is that it's really hard to use one metric and have it as the panacea of all. I don't know any investors that just rely on profit or rely on credit ratings as their sole insight on which they base their investments. So why would you expect an ESG rating to do that? We need to give strong signals that are meaningful, but they're basically simply a sniff test. And that's how you should see them. And from that sniff test, you can drill down, look at more detail, and figure things out, keeping in mind that you have to look at these really large portfolios and you can't spend hours and hours looking at every single company. So I think from that perspective, I think there's still a very long road to be on for us for many years. But I do think that as an industry and as an organization, we're making significant steps forward to make it better.
And with that, I'm going to say thank you and hand off for the next stage of our presentation.
Thank you. I look forward to our session.
The many challenges of energy transition have put a bullseye on the back of the financial services industry. Whether it's analysts, investors, or communities, the question now is, what really needs to happen to ensure that the biggest fund managers and investors redesign their businesses to shed climate risk and provide the types of products that investors want in order to stop funding climate change? Tanya Carr is joining us today to talk about what's involved with the biggest financial players and how you get them to stop financing climate change. Tanya works for the Sunrise Project and is focused on their work to move asset managers toward bolder climate change. This work draws on her time at the UN, where she worked at the intersection of economics, human rights, and climate change. She has experience engaging multinationals on complex sustainable development issues. I should also note Tanya spent much of the last month or so working with a range of stakeholders on things like the Exxon shareholder vote, leading to the first meaningful change we've seen on the board of a global energy major. So Tanya, welcome. Thank you for joining us. I was hoping you could get us started by walking us through your analysis of what's wrong with the leading asset management firms. In a nutshell, why has it been so hard to get them focused on climate change as a foundational financial risk?
Thanks so much for having me, Melissa. And let's see, how much time do we have? There are so many ways to assess the shortcomings of the asset management industry, but I'll try to broadly highlight a few key problems. I think it's clear that the leading asset managers fundamentally misunderstand climate risk. The big three, BlackRock, Vanguard, and now Fidelity, which recently overtook State Street, collectively account for over 20 trillion in assets under management. That's nearly equivalent to the GDP of the US. That's a massive share of ownership of the global economy, yet these asset managers have failed to act in a way that protects the global economy from what is arguably the biggest threat of systemic risk, which is climate change. BlackRock and Vanguard are two of the most egregious laggards in the industry, which is why they have been targets for our finance campaigns. As the biggest investors in the vast majority of S&P 500 companies, BlackRock and Vanguard have enormous exposure to the full breadth of the economy. Vanguard alone has stakes in more than 10,000 companies. This entails a significant amount of influence through shareholder power, which these firms could easily leverage to push their portfolio companies toward more robust climate action, but they don't. As a result of growing criticism of their shareholder voting, BlackRock and Vanguard have only begun to make limited disclosures of their votes on climate issues, and usually well after the decisions have been made. Though they have improved slightly, BlackRock's voting is still inadequate to address climate change with minimal and inconsistent votes in line with climate goals. The statistics are actually particularly staggering when we look at climate critical sectors in the US. So sectors like energy, utilities, banking, industrial, and automotives. In general, market leaders at BlackRock and Vanguard continue to shield management from accountability. And these are management and executives from some of the most carbon intensive companies. And this just undermines global investor action on climate. Both investors have historically voted for company proposed directors almost 100% of the time. They side with management far more often than their peers and their competitors. BlackRock and Vanguard also tend to vote overwhelmingly against climate shareholder resolutions, even ones that are flagged by Climate Action 100 Plus, which BlackRock joined last year in the wake of Larry Fink's promise to center climate in a renewed emphasis on sustainable investing. What's really disappointing, though, is that several of these critical climate votes would have received majority support of voting shareholders if these two giant asset managers had voted in favor of them. So there is a real dissonance between rhetoric and action. Despite public commitments to align portfolios with the goals of the Paris Agreement, the biggest fund managers have actually increased investments in thermal coal, which is the dirtiest and the deadliest fossil fuel, since 2016 when the Paris Accord, was signed. This year, Vanguard actually dethroned BlackRock as the world's largest investor in coal, but BlackRock still remains a very close second. Both firms actually recently signed on to the Net Zero Asset Managers Initiative, but they continue to be, the top funders of fossil fuels and climate-harming projects. They continue to pour billions into the most critical emissions-intensive companies, and that just makes their recent promises to integrate climate into business practices seem like nothing more than greenwashing. BlackRock and Vanguard seem to be concerned with protecting themselves from the impacts of climate change rather than curbing their own contributions to it. So we need to move the needle, and so far the progress has simply not been at the scale or the speed necessary to actually make the difference that we need.
Tanya, you've just done a really great job of highlighting in a very structured way, sort of the best critique of what's wrong with these big players and where, quite honestly, they're beginning to diverge from the behavior of many of their peers. Why do you think the big passives firms have been so distinctively resistant to change? Is this a market problem, a regulatory problem? Where's the gap here?
So I think you actually mentioned a big part of the reason why the industry has been so slow to adapt to environmental realities, and that's passives. The first index fund was actually created by the founder of Vanguard, John Bogle, and it passively tracked the S&P 500. These mutual funds were an innovative new way to invest, which offered broad diversification, low risk, low fees, and strong long-term returns compared to active investment by selecting and tracking certain individual stocks. Now, passives have completely overtaken the financial sector. Passive equity investments have actually surpassed active equity investments in the US, and the trend is surging globally as well. Index investing has not only set the economy on autopilot toward a climate cliff, it's also turned the asset management industry into an oligopoly that is quickly becoming a duopoly dominated by BlackRock and Vanguard. So from a macroeconomic perspective, I think this can be seen broadly as a market problem. It's about the profit motive, right? Power is becoming increasingly concentrated with a handful of investors, shrinking over time, who have minimal incentive to deviate from business as usual. So asset managers are extremely set in their ways. And they're not really inclined to engage or vote in a way that will risk their own viability as a business. They don't want to lose access to sources of corporate power like executives and senior management and corporate boards. They don't want to lose clients, including fossil fuel companies that bring in millions of dollars of revenue every year. When they're in the business of, funding the retirement of these kinds of clients, they don't really have that much of an economic incentive to shift the business practices of those clients. But investors who own such a representative swath of the whole market should be aligning incentives and interests with the whole market, not just the potential profits and losses of individual companies. The market has actually evolved in a way to create all the wrong incentives for climate. Asset managers should not be focused on low fees or low cost products. they should be focused on not killing the environment, and they are just simply not doing that. The returns are just not there for them. So the other aspect to this is that there's lots of blame shifting going on. You know, asset managers have amassed so much power that they can hide behind asset owners. They can hide behind index makers and index providers and other consultants for inadequate action on climate. But the way passive investing has evolved, it's really shifted power away from asset owners toward asset managers. So now asset owners have a relatively small share of the money compared to the largest asset managers. And therefore, they're really in a worse position and much more disadvantaged to be able to pressure index providers or their asset manager clients to change investment strategies. And you see that sometimes with certain asset owners, they do get very frustrated when this is happening. So these kinds of power imbalances and these kinds of power plays create further market flaws, which just further entrench fossil fuels into the economy, and which just, it just keeps exacerbating the climate catastrophe that we're in. So short of restructuring the entire market, we absolutely do need stronger regulation. That's definitely a course that we can take. We do need government intervention to realign incentives away from following a free market ideology, which will ultimately destroy the planet. The opportunities are there. And if they want their businesses to remain viable going into the future, they just need to find those trends and then get ahead of them.
One of the things that I find fascinating and at times obviously tremendously frustrating about this question about the biggest asset managers is that when you look at other markets, when you look at Europe, not only do you see a lot of competition around better solutions when it comes to dealing with the impact of climate change and addressing the problems of financing high carbon assets, but you see a lot of innovation. What types of solutions do you think are going to really push the market now, and what changes would you like to see in the industry?
I mean, this is the eternal question, right? And I think you bring up a good point. Europe has really been making a lot more progress than the US. And I think other markets and other places as well, the US has really been dragging a bit far behind. And I think they should look to some of the examples that Europe is setting on some of these climate policies. But, Vanguard and BlackRock, these major American behemoths in investment have recently made some moves on climate, but it is nowhere near the visionary financial leadership that we need. Time will tell if they actually uphold these pledges that they've made recently and these commitments that they're making. But there are certainly some things that these kinds of asset managers with unmatched economic influence can do to accelerate the kind of transformative change that we need to see. I think the consensus from the climate activist community, I think, is one of the best solutions would be offering climate tilted products as the default offering. Currently, clients and investors need to jump through hoops to be able to opt in to ESG and sustainable funds. It's not the thing that's readily available and right there. They need to go through all of these backdoor channels and figure out all sorts of ways to try to get there. It's not so obvious. And that needs to change. That needs to be completely turned on its head. And because it is an opt-in situation, it obviously means that these kinds of funds that are more sustainable and more socially responsible are only going to be constituting a small minority of the total assets under management. BlackRock and Vanguard really need to start looking into providing fossil-free and deforestation-free funds as the default option for investors and clients across all its product offerings. And I think they're going to see that that's also going to help them be more viable as a business. I mean, we're already hearing that places are disappointed with the way they are handling climate and the way that they are handling socially responsible investing, and that they're not really where they need to be, and they're going to lose clients from it over time. So they need to, once again, find that trend and get ahead of it. I also think this leads to a discussion about what needs to happen long term. And I think, removing climate destruction from active funds is a good first step, but it's inadequate. The impact of that will actually be minimal if climate is ignored in passive funds. So these big asset managers must also adopt robust exclusion policies that screen high-risk, emissions-intensive companies from its portfolio And then, of course, this will, the logical conclusion of this is that they will ultimately need to exit industries that have no viable climate transition plan. BlackRock actually said that it's fully exited companies that generate more than 25% of their revenue from thermal coal production in all its active funds, but that threshold needs to be lowered to 0 over time. 25% is not really the bar that we're looking for. They actually should use the global coal exit list as the basis of the kinds of sectors that they need to exclude and exit, in addition to tar sands, oil drilling, those kinds of things. And all of this, I think, goes hand in hand with the fact that we need to define universal standards for ESG criteria. This would ideally be legally enforceable so that it can apply across all companies, across the whole economy, across the entire financial sector. And this would allow loopholes to be eliminated. This would allow companies to avoid the potential for greenwashing. So these kinds of economic steps are possible. They're totally possible. I just think these companies are in a very comfortable position and they don't want to do it. Finally, I think aside from all of the actual financial things that can be done, these kinds of asset managers need to step up their game on pro-climate engagement and voting. They will need to embrace the full breadth of their power in the ability that they have to sway company directors and management through their massive shareholder influence. And they need to vote in a way that reins in any sort of bad behavior on climate. We are starting to see some success with proxy voting, as you mentioned, with Exxon and everything, but it is just not enough. It is not happening at the speed that we need, and it's just not happening at the scope that we need either.
Tanya, thank you. I really look forward to getting you in front of our audience and in discussion with Diederik.
Thank you so much.
Well, we're delighted to have had 2 great videos, and we've begun to see some really good questions in the chat. To get things started with Tanya and Diederik, I want to frame one question that really builds off some of the discussion that you just heard in their presentations, that speak to the work they do and the perspective they bring to this investment discussion. So Diederik, you clearly have a preference for looking at ways to change ESG outcomes by working in the system, by working with providers of investment products and services. Whereas Tanya, you frame the issues from the perspective of investors and advocates focused on climate outcomes, who want to change the way that our markets are working. So there's an obvious question here, which is insiders either need to work harder or outsiders need to push much harder. Tanya, I'll start with you. What do you think the missing ingredient is right now?
Thanks, Melissa. So I think, you were talking about the 2 pieces of the puzzle that need to come together. I mean, I have a little bit of a bias. I do think people in the industry do need to be doing a lot more. I do think with the amount of power they have and the influence on the market, they have the responsibility to be doing more, and they're not. I do think pressure is coming from the outside. And I do think pressure will continue to grow, especially as these issues become more and more urgent when we hit these climate deadlines that the scientific community has been talking about for years. But I think the bottom line is the asset managers as they exist today have too much power, and they shouldn't have as much power as they do. It is becoming increasingly concentrated. And I think regulation could work. I think regulation needs to happen, but I do think there needs to be more overhaul so that the market doesn't continue to evolve the way it has. Some of the regulation that could come would be, if some of these major AMs and these major finance players could be regulated as SIFIs. But, I do think, it's not out of line to say that they could be broken up, and we could kind of have some government intervention to break up some of these bigger AMs, based on their size, based on the amount of assets they own and how much ownership of the market they have. But, along the way, I do think you can have significant legislation and regulation of the finance industry to make sure that it doesn't keep getting worse the way it has been. I mean, as I said in my presentation, I mean, BlackRock and Vanguard are dominating the market in a major way. And that's kind of making it unfair and making it so that other options are not available. And that's always going to be bad for consumers, and that's going to be even worse for the planet. So I definitely lean much more heavily towards market restructuring in terms of the missing ingredient. I think for me, it's about, you know, the urgency that these industry players need to feel in order to start moving the needle a lot faster.
Diederik, that's a pretty specific agenda. How does it look from your side?
Right. So I think indeed, like what Tanya says, you need both, right? You need change from within and you need systematic change. And I think my philosophy is that systemic change is really hard. And I think sometimes you can just achieve more from change within. And I think there's many ways to get there, right? I think you can say that there needs to be a minimum standard, or what you can say is you need to encourage people to take next steps into, and I think both of those are really important. I think on the systemic side, what I think is really missing is that shift towards, let's say, away from shareholder primacy to really a stakeholder model where the investor is not central in every decision making and is the one party to be looked at, and really broadening that to the broader stakeholders, I think is really crucial. And some of that shift is happening, but it's not fast enough. And the issues at hand are super urgent. And I think the work that I do is very much focused on enabling investors to move. But I think there's much more needed, right? There's a need for demand creation. I think there's a need for raising of standards. And I think there's also a significant need for ensuring that best practices and good things that are happening also are being highlighted, so that you have that whole combination of factors that together create that change that we all want.
There's a really good question in the chat that dovetails nicely with something that Tanya and Diederik and I have been debating back and forth, which is we're fortunate to be doing this panel in a really interesting time because 2 weeks ago we saw a type of event take place that we haven't really seen on this scale, which was the vote that took place at Exxon, where engine number 1 put forward a slate, and now 3 of those proposed directors have won a position on the board for the first time with significant voting by a number of major US institutional investors. Zane had a good question about how we see that issue as a panel. Tanya, do you want to kick off? Because this was a major event. How does it look to you?
Yeah, I think that's a great question, Zane. I think when we look at the Exxon, board vote that happened, I think that was a major victory for climate everywhere, for the planet. And I think engine number 1 did a great job, and the little engine that could and did and won. And so I think that was really a significant moment. And I think you can see that there are kind of boutique hedge funds like them popping up, and I think there will be more, especially as the majority of investors do become more socially conscious over time. They will be looking for those kinds of products like that engine number 1 and that companies like Betterment that are offering more values aligned investment options. And so I think when they're leveraging their power to change the structure of these companies, that's exactly what we want to see, right? I think that shows that they are responding to the pressure from climate activists, from investors who care about where their money is going. And they see that there is a kind of economic incentive to have these shifts happen as well. And so being able to move a company like Exxon, like largest producer of oil in the US, that is really, really significant. And so to be able to have that happen, I think paves the way for more victories of that kind to be happening going forward. And I think we need to encourage other companies similar to engine number 1 to kind of stage similar fights, because it clearly is possible, as long as we have the majority of investors wanting that. And I think we see that a lot of polls are showing the majority of investors in America do support moving away from fossil fuels and moving towards clean energy and moving toward alternatives. And so this win, with having these dissidents kind of coming onto the board and, starting to run the show there, I think that's exactly what we need to see. And I think we will start seeing more of that going into the future.
Diederik, anything you want to add to that?
So I think that engine number 1 is a massive achievement. So I first want to acknowledge that. But I think there's something else at play here, and that is asset managers are moving, asset owners are moving, they vote in favor of these resolutions. So it's put on the agenda by engine number one, but the work and the voting is done by the broad investor community, and the support for resolutions like this is increasing year over year over year. And I do think that the calling out the asset managers on their voting behavior, and it's easy for a manager not to vote or for an asset owner not to vote. I mean, typically they hold 4,000 or 5,000, maybe up to 10,000 companies. It's a lot of work that needs to be done well. And there's a lot of automatic rules that are being implemented also to execute that voting. And what I'm seeing is that these rules and the proxy approaches are changing so that they can support things like this as well. So yes, fantastic engine number one, but I think it shows a structural change in the finance industry.
I want to attempt something that I'm going to hope will work. We've had a couple of really interesting questions with sort of two related themes. One is from a couple of people asking questions about really what happens when advocacy groups and others win significant legal action against companies. You know, why isn't this filtering more into the understanding of the way investors approach markets? And a linked earlier question about sort of the way information in financial markets and frankly in the public view gets siloed, you know, where we have articles that will be about, you know, Amazon Day is really positive. No one talks about the environmental impact of it, or have, you know, great vivid evidence of the financial impacts of climate change. And yet we've got funds out there where it hasn't been integrated, and far too many situations where investors are not getting the information they need to link things. So Diederik, I was hoping you could talk a little bit about something that I often feel people don't understand well enough in the work that firms like Sustainalytics does on controversies. People oftentimes focus on scores, but Sustain analyzes controversies. And this information has begun to have a lot of impact in the way investors look at it. And I think that's one of the pathways in here. I'm hoping you could talk about that a little bit, and then maybe we'll move on to the question of fiduciary duty.
So I think investors, again, they look at large portfolios of a lot of companies, and therefore they need to have simple tools to have a snapshot of a portfolio and to have a quick take on how well a company does. That's basically the function of a research organization like Sustainalytics and MSCI and others. So we used to have clients mostly looking at ratings, which is a very broad sniff test on a broad set of environmental, social, and governance factors. And the reality is it's just one score. And that one score can't tell the whole story, right? It could be that a company's really good on environment, really bad on social, or they're great at telling the good things they're doing, but they're terrible at telling the things that don't go well. So what we started to see is that companies that have really significant incidents that occur often have a whole pattern of incidents before, because they go to areas where there's really high risk, or they have practices where even though they have good policies, the implementation of these policies is not done. So controversy signals the level of involvement of companies in egregious events is a super important signal that often is used alongside the sniff test rating in that way.
Tanya, I'm curious, given what is beginning to go on more and more in markets and the work you've done on asset managers, there have been periods where people in the sustainable investment field have spent a lot of time focusing on fiduciary duty because it's really the linchpin in terms of the regulatory structure. Is that something that you've looked at, and what's your sense? Is this a leverage point? It used to be that traditional regulators would say a fiduciary duty construct means you don't look at environmental, social governance issues. Increasingly, that's not the case.
Yeah, I think fiduciary duty is one of those things where, yes, the asset management industry always uses that. And I think sometimes it's valid. Sometimes I think they hide behind it in order to just focus on making sure that they're just getting the returns for their investors. But I think it needs to shift a little. I think, fiduciary duty needs to also make sure that, you can get those long-term returns without also, destroying the environment and focusing only on fiduciary duty with, short-term gains. I think they need to have a more long-term view of these kinds of things, especially the like implications of what some of these investments are going to do. And so the like scope of fiduciary duty needs to change over time. That definition needs to incorporate what the fiduciary duty might end up causing, you know, what kind of harm it might cause, and not just about the fact that they want to make sure they're making their investors money, because you can make money in a lot of different ways. And I think we've seen, you know, even the recent IEEFA report that came out, like fossil fuels are losing investors money. And so I think fiduciary duty there is, you know, not quite an adequate excuse to be able to still put money into these companies, because you're not really, you know, looking out for the bottom line of the company or the investor. You're just doing something because it's convenient and because you're really set in your ways. And so I think there needs to be some way to reconfigure the way fiduciary duty kind of comes into play when it comes to these things.
So if I can add, I think you make really good comments, Tanya. So I think the thing that I see is that ESG integration, so the factoring in environmental, social, and governance factors into your evaluation of a company from a risk lens is happening across the board by many investors. But it doesn't mean that these portfolios are necessarily only or mostly containing companies that have positive impact. They have slightly less negative impact. And I think that's where the confusion is coming from. ESG, so environmental, social, governance integration, leads to a slightly better portfolio with a lower risk. But it doesn't mean that you invest in those technologies or in those things that do much better. And I think there's a lot of confusion around the language that's being used. And I think a good example here is that the EU action plan and the taxonomy that is being implemented across Europe, for instance, ESG integration is not seen as a sustainable investment strategy anymore. So I think that's the first step that's being taken, as integrating these factors in your modeling doesn't mean a sustainable fund.
That's a really important and quite powerful point, and something that Tanya and Diederik and I were discussing before we went live really goes to the heart of this issue, which is we're beginning to see a very different trend of regulation in Europe, where quite honestly, Europe is really setting the standard. And as the different players in the market now are really relating to the issues and competing against each other now in terms of wanting to get rid of it, put pressure on products and issuing habits that result in a lot of greenwashing. We're just seeing a very different dynamic. Tanya, I'm curious from your perspective, you know how campaign and market development goes. Is there going to be a scenario where we can get a US voice that begins to say it louder, we need to come closer to what the Europeans doing? Or how do we put a US or a North American face on this? Because we're certainly lagging. We're definitely not offering much choice. And we do have these very big players that are offering products that no one seems ultimately that satisfied with.
Yeah, that's really true. I mean, Europe is really setting some good examples for what the US should be doing, especially with this green taxonomy. I think that is starting to be incorporated a little bit here. I know I think it was in 2018, BlackRock, usually has pretty loose standards for their environmental social governance funds. They started marketing new European ESG ETF products. And so if BlackRock can start to do it, I think, being the largest asset manager in the world, that is kind of a good sign. I think if they're starting to feel the pressure to be able to move to the more progressive stands that the European companies are starting to do, I think it might start to spread throughout the market a little bit more, where then BlackRock's competitors will start feeling a similar pressure to move towards the same policies. But with the US or the European green taxonomy on the horizon, and then coupled with the fact that we are seeing growing investor demands for better, cleaner ESG products, I think we will start to see more of a call for that level of kind of standardized ESG funds in America and hopefully in worldwide.
I want to turn our attention. There's a really, really important question in the chat, and it's also a really challenging one. So I want to make sure we have some time to talk about it. About the question of what happens is, we're all aware of the fact that ESG analytical tools aren't perfect. As a community, we've pushed ourselves very, very hard to learn how to analyze the issues at a policy level, at a geography level, at an impact level. And we are beginning to see companies respond. One of the financial byproducts of that is we are beginning to see significant companies with a lot of assets that they now do not want. And many of those assets, whether they are end-of-life fossil fuel power plants, older oil and gas facilities, highly polluting plants of various descriptions, they're now beginning to wander off into the private realm. Some of that is in the second tier of the private equity world. Sometimes the predominant financial assets sit in debt products, oftentimes down in less skilled pension funds. Who's thinking about how we as investors and more broadly as a financial market attend to the fact that we're going to have this sell-off, and a lot of it is effectively going to go to dark places. Now, Diederik, I'm going to be a little unfair, but I know you know a lot about the products and services that are beginning to grow in the market. Are we simply going to lose sight of these products and these risks then just accumulate in other pockets? How do you think this is going to play out? Because good investors want to be able to value things and to assess risk. So where is this going to happen?
So let me start by saying that if things are moving away from capital markets, that's not a bad thing. It means that there's less availability of capital, right? So less options available. So I think that's the first point I wanted to make. Less availability of capital will result also in difficult financing. Then the other bad news for these kind of companies is that sustainability and ESG is coming to private equity as well, where you see a large number of asset owners having focused on the equity and fixed income side. They're now going to private equity, to infrastructure. And the challenge here, of course, is that a lot of these organizations are not so transparent and you don't really know what's going on. So I think the most significant challenge here is how do you get the information you need to evaluate that well? I think the asset owners are interested in doing more, but the tools are currently really being developed. And I do think that new types of technologies will really help out here. And I think a good example is, for instance, that you're increasingly seeing satellite images used also by investors to understand, for instance, the physical risks that companies are having, or the tailings dams are fully being mapped, et cetera, et cetera. So I think in that way, the availability of information is no longer limited to what a company reports.
I want to open up another question that's come through in the chat about really about plastics, which of course is an area where IEEFA has been doing quite a bit of work and certainly expects to do more. I think the word nuance pops up in this. There are so many different ways to think about the challenge of plastics as it intersects with the issue of oil and gas companies, where they're expanding, why they're expanding. Tanya, can you give me a sense, is plastics an area where you think there is a lot of leverage in terms of working with advocacy groups and campaigning, and how do you think this will come into the investment lens?
Yeah, this is a great question. I think there is a lot of work being done right now on plastics and petrochemicals at large. And I think it definitely relates to the oil and gas industries so clearly. And this is something that, you know, especially as we are seeing the effects of climate change, particularly on the oceans and the bodies of water, plastics are the biggest polluter. And there is a lot of mobilization around how we can reorient our industry and our production and our consumption so that plastics are not, you know, as big a threat to ecosystems as they currently are. So yes, there is a lot of potential for leveraging some power there. I think the way that people are starting to wake up to fossil fuels, it's just a matter of time before, you know, all of the push for, you know, anti-plastics and all of that start to take hold too. You can see there is a lot of overlap between the industries. So as soon as, you know, this, you know, as soon as we start to see more, I guess, successes in like pushing for oil and gas regulation, I think we'll start to see, you know, it'll just kind of start automatically sliding into other arenas that are related. And plastics is definitely one of them. We are doing work on plastics campaigns and trying to figure out how we can, you know, move certain companies away from investing in that, how we can kind of change the way people are viewing plastics. We're already starting to see in lots of cities around the world plastic bans. So it is something that is kind of popping into the, kind of national and international consciousness. It's just going to be about how we can then use that to kind of get that to a higher level in terms of the way the industry is supplying these goods and investing in them.
So one of the things that we have been debating back and forth when we were getting ready for this panel was really focused on this question of, how do you get investors? And in a US context, how would you get retail investors and people who come home late at night and really don't want to think about their 401k? What are the tools that are going to really make it possible to create stronger stakeholder pushback and to really begin sending a message to product providers that people want to be making choices that are frankly much more integrated? Diederik, I know you think perhaps it's not a product-driven thing. Tanya, I'm curious, is it a messaging process? Is it a political process? How do we actually generate more innovation and innovation that lasts?
Yeah, I think this is the question, right? Especially for the climate movement. How do we actually win in this battle for the planet? And there are a lot of tools. I think when it comes to retail investors, a big part of it is going to be educating them on product offerings. I think a lot of people, like you said, they're working all day, they come home, they don't really have time to investigate, and they just want to put their money into an index fund because that's easy and it's very low maintenance for them. But I think if they knew where that money was going, if they knew this is where the retirement money is actually getting invested into, and this is where the college savings money is being channeled to, I think that would make them start caring. And I think there is just generally a very low level of awareness of where the money is actually going and what they're actually kind of contributing to funding. And once we raise awareness of these kinds of issues, I think it'll be pretty easy to mobilize clients and customers into action against the company. I think when you put someone on the spot and say like, hey, your retirement fund is actually funding a coal plant or an oil pipeline, I think they're going to not feel so great about that. And I think they're going to want to get involved. And there already has been, through the BlackRock campaign and now the Vanguard campaign that we're running, we are getting lots of interest from individual investors who have their money entrusted to these companies. And they're saying, well, this doesn't seem so great. I didn't know about this, but now that I'm starting to hear more about it, I want to know what I can do to try to move my money, make a difference, get the company to become a little bit more progressive on these issues, because we're on a deadline. And I think as soon as we start educating people, we can start moving those companies a lot faster because they will be responding to threats to their bottom line. If companies are affected by lots of clients trying to move their money en masse, I think that will kind of shake them, and that will let them know that, okay, this is clearly going to affect us as a company. Let's see what we can do about it. But in terms of, retail, it is going to be about getting the consumer base involved and making sure that they are aware of what they're financing and how they can change some of the way that they're investing their money.
So Diederik, I'm gonna leave you with one last shot at this, but I want to tweak it a little bit because we're coming back to something you talked about in your video about the importance of regulation, but also in Europe, they have really, really focused on this issue of fund managers being held accountable on what they say about their products. Is this an area where there is a clear pathway on regulation in the US that we could be focusing on?
Yeah, so the regulators, including the SEC, are really starting to get data in their hands so that they can understand the characteristics of funds, also on the sustainability and ESG side. So there's a lot happening there. Then the SEC has also started to do audits related to funds that have sustainability or ESG within their prospectus. And then there's questions, what does it mean for your investment process? How do you implement this? And I think that will really enhance the vigor of a lot of these funds. So I do think the regulator is certainly looking at this moment in time, and I think it will help. Coming back to why individuals don't pick up these funds, I think there's indeed a whole gap. And a good example here is we just did a survey at Morningstar, and we interviewed 3,000 individual investors we found that only 15% of people understood the term sustainable investing and 12% understood the terms ESG. So I think there's a whole lot of education that needs to happen before people can also then move their money to these kind of investments.
Tanya, Diederik, I really owe you a debt of gratitude. Thank you for working so steadily with us to make this panel possible. I have to say, trying to tackle a broad range of investment issues is never easy. I also want to thank everyone for the great questions in the chat. We've done our best to cover a lot of ground. And if you have questions you'd like to come back to us with, we'll make sure that we do what we can to come back to you with answers. Tanya and Diederik, once again, thank you so much. Clearly, we all have a lot to do. And Sandy, now over to you.
Great. Well, thank you so much, Diederik, Tanya, and Melissa. That was a great discussion to close the conference with lots of ideas about how the investment community can accelerate the global energy transition. We hope that you'll stay on for another 10 minutes here to watch the fourth in our series of videos on local leadership, global change. This short film features the extraordinary work being done in Poland to move the country away from its historic dependence on coal-fired power. If you haven't already watched our other films on the Philippines, Bangladesh, and the Navajo Nation and Hopi tribe, I hope you'll do that as well. As we bring the conference to a close, I'd like to thank the people who helped us present this 2-week-long event. These include our wonderful group of speakers and moderators and the leaders featured in our film series, all of whom shared their insights and expertise with us. Our generous funders who supported holding our conference in cyberspace again this year. Our very talented conference production team who worked behind the scenes to design and run the event, including Bethany Ruggiero and Melissa Logan at Strategic Event Design, Philip Dolan and Molly Bernstein at Particle Productions, music composer Michael Leonhardt, Babette Roberts and her team at the Back of the House Productions, Ann Lieberman, and many members of the IEEFA team, especially Vivian Heston, Amanda McConnon, Annika June, Seth Feaster, and Rachel Kent. And of course, we thank all of you for joining us. We hope you'll take a few minutes to fill out the feedback form that you'll receive in your email and is also in your chat box. And if you'd like to come back and watch any of the recordings, they will be all archived on IEEFA.org, as well as on this conference website for 1 year. We wish safety and good health for you and your families in the coming year. And we look forward to seeing you again, whether in person or online in 2022. Thanks again and goodbye.
My name is Michael Hadmansky, and I'm economist and president of the board at Instrat, a Warsaw-based think tank that is focusing on energy transition from coal to clean energy sector in Poland and Central and Eastern Europe.
My name is Diana Maciąga, and I've been working with a Polish NGO, Pracownia na Rzecz Wszystkich Istot, which is completely unpronounceable, so we translated into Workshop for Well-Being. For the past 31 years, we've been working for protection of the natural values of our country, Poland, to protect both wild animals and habitats.
My name is Ilona Jędrasik, and I'm leading a fossil fuel infrastructure team in Poland in an organization called ClientEarth. ClientEarth is an international organization which focuses on environmental law. My team focusing on Polish coal issues, all these pollutions which are connected to coal, and we are trying to make Polish energy system greener and safer.
My name is Sophie Marginak. I'm the climate accountability lead at ClientEarth. I'm based in London, but our team works on climate law and litigation all around the world.
My name is Kuba Gogolewski. I'm based in a Polish non-governmental organization that's called Fundacja Rozwój Tak, Odkrywki Nie. That would be development yes, open pit mines no. We are representing a coalition of local communities, local authorities, experts, and scientists who since 2011 have been opposing plans to build new lignite mines. And we've been supporting those communities, working on the transformation of a Polish energy system.
Our long-lasting campaign for coal phase-out in Poland started with the first campaign concerned then the biggest new power plant in Europe, the North or Północ. And the campaign was successful. We managed to stop construction of this facility. And later, we campaigned to stop construction of the infamous Ostrołęka C coal project.
Ostrołęka was a symbol. It was the last plant that was decided to be built in the EU. The decision was taken after a lot of campaigners, including us, saying that it doesn't have economic sense, that it will never pay off, that it will be a stranded asset. Still, the two state-owned utilities decided to start operation, even though they didn't have financing secured. We played a big part in reaching out to international insurance and reinsurance companies, explaining what are the faults and problems with this project, and the project was dropped.
The biggest argument against Ostrołęka C was actually that this is not anyhow aligned with the European and global climate policy. And we proved with analysis made by experts that this coal power plant block is never going to be profitable for the companies and should not be built.
Luckily, the construction started, but it was dropped. And I think there's a message there. We used to think that when the construction starts, it's usually done deal. Ostrołęka started construction at the end of 2018, and the decision to cancel it was in May 2020. So last year it was abandoned and became sort of a symbol of a stranded asset in the making. We've wasted 250 to 300 million euros on building two pillars, and that's the money that didn't go to transformation.
Poland is one of the most coal-dependent countries, not only in Europe, but also in the world. And at the moment, we still produce around 70% of our electricity and around 70% of heat from coal. Coal has a significant role not only in the energy sector as a system, but also when it comes to the individual heating. So we still use coal to burn in domestic stoves.
These are very small boilers that have no environmental pollution limits. They are very outdated. The coal used there is a non-classified kind of coal that is very pollutive, and Poland has one of the highest number per capita of premature deaths caused by air pollution, coming mostly from individual heating.
This impact of coal in Poland is visible not only in CO2 emissions, but also in the other environmental problems such as landscape, such as protection of soil and protection of water.
Public opinion is much divided about the energy transition in Poland. Many people in Poland still consider coal as something very concrete, your own economic resource, that is coal that you extract from underground, and this underground has been defended by your ancestors. And even 2 or 3 years ago, you could hear the president of Poland, Mr. Andrzej Duda, saying that Poland has enough resources to extract and burn coal for the next 2 centuries.
When I started working for ClientEarth, the share of coal in the electricity sector was around 80%, and within this 10 years, we actually reduced the coal up to 70%, which is significant, but still is way too much to actually talk about decarbonization of the Polish energy sector. And within these 10 years, we improved significantly development of prosumers energy, so this micro-scale energy. We significantly improved the energy efficiency, but there is still a lot to do to get rid of coal. Even 40, 50-year-old energy coal power plants are still active and they're still producing energy in Poland. Bełchatów is the second biggest lignite coal power plant in the world and the biggest single coal power plant in Europe. It's also the biggest single CO2 emitter in the entire European Union. Bełchatów is lignite coal, so it's not only gigantic, it's also using the dirtiest form of coal, which makes extremely huge impact on the entire environment, on the water regime, on the air pollution, local fauna and flora. We decided to actually make the first civil case against Bełchatów power plant in Poland. We used the article from the Polish environmental law, and which said that if there is any installation which impact on the environment is big, and this impact is impossible to reduce by any technological way, then the environmental organization or the local community have a right to actually demand this installation to be shut down.
Those last remaining coal power operators are really being squeezed out of the market, and then hence we've seen the announcement by the Polish government that they will close Bełchatów by 2036, which is not in line with the science. As we know, coal in the OECD needs to end by 2030 at the absolute latest. So that is still too late, 2036, but at least there's an acknowledgement from the government that there needs to be a conversation about a coal phase out, which is a first for Poland.
We need to start closing coal power plants, and the first step for it would be actually announcing the date of coal phase out. We don't have it in Poland yet.
The government will never say it is our brave decision to phase out coal. They will do it step by step. These steps are never announced as a coal phase out, so you should read between the lines to see that the government approach is changing. And numerous institutes, researchers, analysts, including Instrat, is showcasing different scenarios to switch from coal to other energy carriers and sources.
There is this completely different idea for an energy system. We sometimes call it this virtual power plant. So it's not one huge facility, but basically every house becomes the producer of energy. It can be done with photovoltaics, with wind, with biogas. The municipalities, so these local communities, can have their own mini renewable power plants. And if we also reduce the use of energy, we can become independent. This also means that people are becoming independent from these big energy corporations, that they reclaim power. So it's literally power to the people. And this is also one of the reasons that the government, which controls energy production in Poland, doesn't really want to let go of this power.
Uważam, że polscy politycy i polityczki zbyt długo są bierni, nie podejmując działań, które będą chroniły nas, obywateli, obywatelki, przed zmianami klimatu.
This is a case brought by 5 Polish people. They are all seeing the effect of climate change in their everyday lives. They are bringing a human rights case to 5 regional courts in Poland, alleging that Polish personal rights and human rights require the Polish state to reduce its emissions in line with the goals of the Paris Agreement.
Zdecydowałam się podjąć działania prawne, dlatego że świat już jest o 1,2 stopnie cieplejszy, jeżeli weźmiemy pod uwagę poziom przedindustrialny. Taki świat jest już katastrofalny. Ja nie chcę, żeby moja przyszłość też tak wyglądała. Nie chcę, żeby teraźniejszość tych osób też tak wyglądała.
Poland really owes it to their citizens to step up to the plate and face the reality that fossil fuels are a relic of the past, and that on a pure economic and political level, as a member of the EU, they are holding themselves back by failing to transition at the same pace as the rest of the bloc.
I'm partially optimistic in a sense that I know that there is a lot of things that can be done and will be done, but looking at the big picture, I think we really need to speed up.
There's still lots to do. We are going to the good green direction, but so far Poland is rather, like crawling than running. So we have to really make them speed up.